Good evening, everyone. Welcome back to Boss Economic World. I'm your host, here to peel off the layers of financial jargon, expose the naked truth behind the numbers, and hopefully, keep you from losing your shirt in the process. Today is November 26, 2025. Mark this date. Seriously, write it down on your hand, tattoo it on your forearm, or just save this video. Because something just happened in the global financial plumbing that we haven't seen since Harry Potter was still in movie theaters. For the last 14 years, since July 2011, to be precise, betting against the Chinese Yuan was the cool kid trade on Wall Street. It was the default setting. You wake up, you drink coffee, you hedge against the yuan falling. It was as reliable as a rainy day in London. But today? That streak is dead. The gauge is neutral. The bears have gone into hibernation. What does it mean when the smart money suddenly stops betting on a currency crash? Why are Goldman Sachs and the folks over in Singapore suddenly singing a different tune? And most importantly, with the US dollar looking like a heavyweight boxer in the 12th round, wobbly and sweating, what should you be doing with your assets? Let's analyze the truth. First, let's look at the data, courtesy of our friends at Bloomberg. We need to talk about a scary-sounding term, one-year risk reversals. I know. It sounds like a maneuver in a fighter jet. But stick with me. In the options market, this is basically the price difference between buying insurance against a currency falling versus insurance against it rising. For 14 years, traders demanded a massive premium to protect themselves against the yuan dropping. It was panic money. They were terrified of a devaluation. The chart looked like a heart monitor of a patient in distress, always skewed to the downside. But as of this morning, that gauge fell below zero. In plain English? Traders are now paying the same amount, or even slightly more, to bet on the yuan going up as they are to bet on it going down. Think about that. If you're at a horse race, and for a decade, everyone bet on Horsa to break its leg, the odds are skewed. Suddenly, today, the bookies are saying, actually, Horsa looks like it might win the Kentucky Derby. That is a monumental shift in market psychology. Why now? Why, in late 2025, has the narrative flipped? Christopher Wong, a strategist at OCBC in Singapore, put it simply, it's the dollar story first, yet it shows the balance of risk tilting more towards renminbi upside. The US dollar is losing its mojo, and the yuan is looking like the best house in a stabilizing neighborhood. To understand the yuan, you have to understand its dance partner, the US dollar. We are standing here in late 2025. Let's look at the American landscape. The Federal Reserve has spent the last year battling the ghosts of inflation, but now? The war is over, and the cleanup crew is here. The US economy is slowing down. The exceptionalism narrative, the idea that the US economy can outrun gravity forever, is fading. Investors are bracing for 2026. They are betting heavily on Federal Reserve interest rate cuts. And what happens when the Fed cuts rates? The yield on holding dollars drops. The carry advantage, the free lunch of holding dollars to earn high interest, is being eroded. For the last 3 years, you could sit in US cash and make 5% risk-free. It was glorious. It was lazy. But now, with the Fed signaling a pivot to a lower rate environment to save a softening labor market, that 5% is vanishing. When the yield disappears, the capital flows out. It goes looking for growth. And where is it looking? Surprisingly, it's looking east. Now, let's talk about China. If you read the headlines from 2023 or 2024, you'd think the economy had fallen off a cliff. Real estate crisis, debt deflation, youth unemployment. Those were real problems. They are real problems. But here is the nuance that the doomers missed, adaptability. The offshore yuan has strengthened 3.4% against the dollar this year. That's not a rounding error. That is a trend. Why? Because while the real estate sector is still licking its wounds, the manufacturing engine, specifically the new 3, has gone turbo. Goldman Sachs, never one to miss a trend shift, just raised their target for the onshore yuan. Their analysts, led by Kamakshia Trivedi, wrote a note that hit the nail on the head. Despite a bifurcated economy with deficient domestic demand, we think the underlying macro drivers and still significant undervaluation in CNY call for further CNY appreciation. Let's unpack the word bifurcated. It means split in two. On one side, old China. That side is struggling. On the other side, new China. That side is booming. We are seeing a massive current account surplus in China. They are selling more to the world than they are buying. Normally, this drives a currency up. For years, capital flight suppressed this natural rise. But now that the US interest rates are dropping, the pressure to run away is gone. The gravity of the trade surplus is finally taking over. There is a third pillar to this story, and it's political. Markets hate uncertainty. For years, the US-China relationship was a black box of tariffs, bans, and angry tweets. But look at 2025. We are seeing what I call the pragmatic pivot. Beijing and Washington have been quietly mending fences. Not because they are best friends, but because they are both tired. The US needs cheaper goods to keep the last remnants of inflation down. China needs open markets for its high-tech exports. Optimism that these trade ties will bear fruit has lowered the risk premium on the yuan. When you don't have to worry about a sudden overnight tariff war, you don't need to buy expensive insurance against the currency crashing. Hence, the risk reversals drop to zero. The People's Bank of China knows this. They've set a stronger daily reference rate for the yuan for 3 straight sessions this week. They are signaling to the market, we are comfortable with a stronger currency. Let's get a little technical for my finance pros out there, but I'll keep it simple for everyone else. We need to talk about the unwinding of the short carry trade. For years, a popular trade was, borrow cheap yuan and buy expensive dollars. You pocket the difference. This selling of yuan kept it weak. But now, look at the spread. US rates are falling. Chinese rates are steady or slightly optimizing. The gap is closing. If you are a hedge fund manager holding this trade, and you see the dollar starting to slide, you panic. You have to buy back the yuan to close your position. This buying pressure creates a feedback loop. Yuan gets stronger - short sellers get scared - they buy yuan to cover - yuan gets even stronger. We are at the beginning of this cycle. This is why the options market has neutralized. The easy money betting against China is gone. So, we have the data, the macro, and the mechanics. Now, let's restore the full picture. What is the Boss Economic World verdict? 1. The dollar is no longer the only game in town. For the last decade, the strategy was buy America, sell everything else. That era is ending. As we move into 2026, we are entering a multipolar currency world. The dollar will remain the reserve currency, sure, but its suffocating dominance is waning. 2. Diversification is back. If you are holding 100% of your assets in USD, you are exposing yourself to currency risk that you haven't had to worry about since 2011. The purchasing power of the dollar, relative to global goods, is set to soften. 3. Emerging markets are waking up. When the yuan stabilizes, it acts as an anchor for the rest of Asia and emerging markets. We are likely to see a broader rally in non-US assets. Commodities, foreign equities, and currencies correlated with Chinese growth are looking attractive. 4. Don't bet against the pivot. The market is telling us that the fear of a Chinese collapse was overstated. Yes, they have structural issues. But the manufacturing machine is printing cash, and the currency market is finally acknowledging that reality. Here is the bottom line. The financial world is like a giant pendulum. It swings to the extreme of optimism, and then to the extreme of pessimism. For 14 years, the pendulum was stuck on China is uninvestable and the dollar is king. On November 26, 2025, the gears shifted. The pendulum is swinging back toward the center. The cost to hedge is zero. The fear is gone. The data is resilient. Does this mean the yuan will skyrocket to the moon? No. Central banks prefer stability over volatility. But it does mean the era of the one-way bet is over. The floor is solid. As investors, we have to stop looking in the rearview mirror at the last decade and start looking through the windshield at 2026. The road ahead has a weaker dollar, a stabilizing China, and a whole new set of opportunities. Don't let your portfolio live in 2024. The world has moved on. I'm the boss. I analyze the truth, so you don't have to guess. See you in the next episode.